Why were toxic assets so dangerous in the 2008 financial crisis? Imagine holding a bunch of loans that seem safe but suddenly turn into ticking time bombs. That's what toxic assets were during the 2008 market collapse. These assets were mainly mortgage-backed securities and complex financial products called collateralized debt obligations. They were tied to subprime mortgages, loans given to people with poor credit. When housing prices were rising, these securities looked like solid investments. But everything changed when the housing market started to decline. Many homeowners defaulted on their loans, which meant the cash flow supporting these securities dried up. Because these assets were complicated and not easy to sell, their true value became uncertain. Banks had recorded high values on their balance sheets, but in reality, these assets were worth much less. The market for these securities was frozen because no one wanted to buy assets they couldn't value accurately. This made the assets toxic because they were illiquid and risky. Banks holding large amounts faced huge losses, but they couldn't sell these assets to cut their losses. This created a chain reaction. As banks lost money, they became afraid to lend money to each other or to businesses and consumers. This fear froze credit markets, making it hard for the economy to function normally. Banks' capital was eroding, and confidence in the entire financial system was collapsing. The situation worsened quickly, leading to a credit crunch and a severe economic downturn. The danger of toxic assets was mainly because they could not be sold easily. Buyers feared hidden losses, so markets for these assets disappeared. Their complex structures made it hard to assess their true value, which added to the uncertainty. Because many banks and financial institutions held these assets, losses spread rapidly across the financial system. This interconnectedness meant that problems in one area quickly affected others. Banks often refused to sell these assets, creating a market where only the worst assets were available. This further reduced market confidence and liquidity. In practical terms, what looked like profitable mortgage investments turned into liabilities that weakened banks' balance sheets. Governments and central banks had to step in with bailouts and emergency measures to restore trust and liquidity. Looking at this from a historical point of view, toxic assets show how risky financial innovations and poor risk assessment can lead to big economic disruptions. The crisis revealed the dangers of relying on complex securities without clear valuation and the importance of market liquidity for financial stability. Understanding why toxic assets were so dangerous helps explain why the 2008 market collapse was so severe and why reforms focused on transparency and better risk management.